This is a very, very bullish chart pattern. This is pointing to 2,600, 27 or 2,650, 2,750 for gold. And that's pretty much over the next like month or two. I think it's imminent. I think we're very close to seeing gold break out, but silver is still pointing to, a month and a half from now, I think we'll be up at 34, $36. So it's a nice potential play. It's a shorter term trade. I do
Right.
think eventually we'll see it pull back and it might be at this value again, 6, 8 months from now. If the stock market corrects, it'll generally pull precious metals down. So to me, precious metals is a buy signal for the next month or so, or 2 months. Intermediate term over the next 6, 8, 12 months.
The recent peak in US Treasury yields has extended the challenging period for precious metals. Today, gold prices are under pressure, slipping to the $2,297 level as reflected in the gold dollar index. At the opening bell, gold declined by nearly 0.32 points, representing a minimal 0.01% decrease in value. ChrisVermeulen, chief market strategist at technicaltraders.com, observes bullish flag patterns on the gold chart since 2023, suggesting potential price targets of $2,600 to $2,750. Vermeulen also anticipates silver could reach price targets of $34 to $36 per ounce, acknowledging its higher volatility than gold and its more significant percentage potential. Year to date, silver has outperformed gold with gains of 27%, while gold has shown returns of about 18%. The surge in silver prices is attributed to increased industrial demand and institutional investments amid geopolitical uncertainties. This environment has also driven gold and the US dollar to new highs this year. Looking ahead, Vermeulen anticipates a significant rally in precious metals potentially late next year, fueled by ongoing financial uncertainties and a growing preference for physical assets and cryptocurrencies amid concerns over traditional banking systems. BMO Capital Markets has raised its gold and silver prices outlook ahead of the third quarter. They project gold prices to average around $2,200 per ounce in 2025, up 5% from their previous estimate. For silver, BMO forecasts an average price of $27.30 per ounce this year, reflecting a 7% increase from their initial forecast. BMO noted that while gold and silver typically move together, silver's performance hinges on global economic conditions, particularly industrial demand. Join us as we delve into ChrisVermeulen's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Gold's been doing very, very well. I like the gold chart in terms of the price patterns that it's been forming. If we take a look at the gold chart, I'll show you what I'm seeing, which is a series of bull flag patterns. And yeah, so if we take a look at the gold chart over the last, really since 2023, it's a series of bull flag patterns, meaning the market rallies up, it pulls back, it rallies, pulls back. More so recently, it's had a nice run and pause, a series of smaller bull flags. This is a very, very bullish chart pattern. This is pointing to 2,600, 27 or 2,650, 2,750 for gold. And that's pretty much over the next like month or two. I think it's imminent. I think we're very close to seeing gold break out and start a rally. Now, a lot of times when you have a very clean chart pattern like this, you can get a bit of a fake out, meaning gold might start to break down. It might break some of these lows. If we were to zoom in a bit, it could pierce these lows there and this one.
Right.
And if it breaks through those two lows, there's a lot of people, short-term traders, who have their stops there. And so we could see it break those. It'll trigger the stop orders, which are usually automated, and it creates a flood of sell order. We could see a sharp drop in gold, and then it rebounds and then starts that rally. And it's called a fake out. The market's trying to shake out the longs before it goes long to the upside. So I like gold from that regard. Silver is very similar. It's pulled back a little more aggressive just because it's more volatile. But again, it's a nice pullback to the 50-day. It's trying to find some traction here.
It looks similar to the gold one.
It is, yeah. I mean, they're all very, very similar. It's a strong rally, controlled pullback, and it is pointing to $34 and $36 an ounce. So there's some really nice upside potential in silver. It always has more percentage potential than gold. It's a fast mover. So I like it. I mean, it's I think any day here or any week, we're going to start to see it run higher. Silver might have a little bit of a shakeout. It might do the same. If gold does it, silver will most likely do it. They tend to kind of copy each other. So it'll be interesting to see how that unfolds. We have had a couple big selling volume days. But silver is actually holding up very well, in my opinion. So that's a good sign. Maybe the market's trying to flush down and there's too many people accumulating it. We'll have to see. But silver is still pointing to it, a month and a half from now, I think we'll be up at 34, $36. So it's a nice potential play. It's a shorter term trade. I do
Right.
think eventually we'll see it pull back and it might be at this value again, 6, 8 months from now. If the stock market corrects, it'll generally pull precious metals down. So to me, precious metals is a buy signal for the next month or so, or 2 months. Intermediate term over the next 6, 8, 12 months. I
Right.
think we could probably pick gold and silver up where they are again, like right now. And then I think like sometime late next year will probably be the big run where precious metals really start to rally. There'll be blood in the streets. There'll be all kinds of financial crisis, people moving to physical currencies and probably cryptos because they're worried about the banks and all that
Right.
stuff. And gold miners will want to take off and come to life.
Recent economic indicators paint a mixed picture of the U.S. economy. First-time applications for unemployment benefits declined modestly last week, contrasting with a notable drop in new housing construction to its lowest level in nearly 4 years in May. This suggests moderate economic activity during the second quarter. Amidst this backdrop, U.S. equity markets showed resilience with a rebound on Tuesday, as the S&P 500 and Nasdaq gained 0.4% and 1.3% respectively. NVIDIA's 6.8% surge following recent declines highlighted the sector-specific volatility in technology amid broader market fluctuations. Analysts remain optimistic about the market outlook, citing robust earnings, ongoing economic growth, and expectations of a Federal Reserve monetary policy shift later this year. They anticipate an 11% earnings growth for the S&P 500 in 2024, driven by companies aligned with structural growth trends. However, ChrisVermeulen cautions that while technology sectors may initially face turbulence due to speculative bubbles, broader impacts on real estate and banking sectors could unfold more gradually with potentially severe consequences. He points to indicators such as slowing S&P 500 sales, rising unemployment, and business slowdowns, which historically preceded economic downturns. Let's get back to the interview.
I think we're going to start to see, sales are starting to slow down. I just saw that
Right.
this morning in the news that SP 500 sales, they think have peaked. Businesses are slowing down. Unemployment's starting to rise. It just broke a 24-month. There's actually a chart here that shows this real quick. Typically, whenever we get this red line, which is a 24-month moving average, when unemployment crosses it, we go into we had a pandemic crisis, the great financial crisis, tech bubble, like multiple. So
Right.
we're starting to see unemployment go up, which means people are going to run out of money. 70% of Americans, and I think it's the same for Canada, live paycheck to paycheck. So if they start losing their job, they're never going to be able to pay for their mortgages or rents. And people who are renting the house to these people now don't have the income to pay for their rental property. And then
Right.
the dominoes works its way up to the head of the snake. The banks are going to be left holding it. All the signs are there that I think we're going to start to see this pick up speed. It's interesting. Government jobs, a percentage of job openings. Every time we see government job openings start to spike and rally, we go into a financial crisis of some sort.
And it's
And
not
they've been
more
rallying.
spiking. Wow, that's so weird.
And it's crazy because as the government keeps like trying to like make everything sound good and the economy is strong and we're good, and they're literally creating more jobs to try and keep everything going and make it look good.
Yeah.
The unemployment is still going up, even though they're creating huge amounts of jobs to try to like cover up the weakness. This year, we saw finally like people have burned through their savings. The COVID bubble of all the savings they had, and now we're minus pretty big numbers. So people have burned through their savings. And so you said, how are the dominoes going to fall, Ivan? I think I don't know exactly how they're going to fall, but unemployment going up, people stop paying their rent, they're not able to pay their mortgages.
Right.
It's going to trickle through eventually to the banks, but I do feel like the stock market will be already headed down well before that. The banking sector, I think, and regional banks are going to get hit very, very hard, but probably not a little bit till later in the bull market. I don't think they're going to maybe be the first to go. Believe it or not, I think the tech space, when that bubble bursts, I think there's going to be a feeding frenzy of people like panicking to get out.
Right.
Because a lot of people who are chasing the big tech bubble and paying the prices now, I think are a lot of the same people who always have bought near a high and they've suffered huge losses afterwards. So once the masses start to panic, the stock market's going to get hit first. The real estate is always lingering later.
Right.
And it takes a while to click in for the masses to realize the banks are going to get hit. I mean, we're reading about it now, but the general public doesn't really, they're not, in tune to the markets as we are.
Recent fluctuations in U.S. equity markets have showcased resilience, with both the S&P 500 and NASDAQ rebounding amidst sector-specific volatility, notably in technology stocks like Nvidia. Looking ahead, uncertainties persist, particularly concerning potential impacts on sectors beyond technology, such as real estate and banking, which could face more prolonged challenges in future market conditions. What factors will be critical in sustaining or challenging this market momentum? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.